everyone, and welcome to I think what is now the 6th of at least 6 and possibly more Tax Insider webinars. This one, Thursday, 26th of August, 2021. Property taxation, joint ownership and partnerships. I've tried to cut down on the number of slides, basically because some of us were getting whiplash. And so I've cut down on the number of slides, tried to make a bit more time for some of the queries. We've had quite a few queries in for this seminar, and we've had some which sort of tie in quite nicely, funnily enough, to the points raised in the seminar. So I wanted to make sure that we put a little bit more time to the questions at the end. I've just managed to waste a minute, so let's crack on. About this webinar, it is a tax-centric talk, surprise, to cover predominantly property investment businesses. I want to emphasize that we're going to be concentrating mostly on landlord businesses rather than property development businesses. A lot of the stuff that we will talk about and cover will apply regardless of the nature of the business activity being undertaken. But there will be some elements that are sort of drill down or focus on property investment businesses rather than property trading businesses. So just please bear that in mind, that we're predominantly focusing on your standard property letting business. So we're going to focus on why we might take on joint or co-ownership, as distinct from just being a one-man band or one-lady band. The basic legal position from a non-lawyer, i.e. me, co-ownership versus partnership and why it matters. I will try and pronounce co-ownership better than co-ownership. Co-ownership versus partnership and why it matters. Key pitfalls and errors to look out for. Okay, so why joint or co-ownership? Well, you've got greater access to finance or spreading the debt burden, and you can achieve economies of scale more easily. If you're capable of dealing with one bad tenant or one bad client, then you're probably well geared to dealing with 10 bad clients or tenants. It allows you to sort of specialize or take on expertise. So you might have one joint investor who is a plumber or electrician or a builder, and another one who has a great deal of experience in dealing with HMOs, and you can pool that talent and enhance the business for the future. Surprisingly, we're going to focus on the tax reasons and tax efficiency, and particularly between spouses and civil partners and family members. So the tax savings. Income tax, making better use of tax-free personal allowances and lower tax bands. Capital gains tax, doubling up on the annual exemption and whatever is left of the basic rate band, so that you can benefit from 18% instead of 28% for residential disposals, 10% instead of 20% for non-residential disposals. Now, of course, if you're dealing with expensive property, these kind of things are marginal, and it tends to be income tax. Having said that, inheritance tax is something that is often overlooked from one year to the next. Now, it's the case over the last few years, particularly that, now that you've got a transferable nil rate band, that you can benefit pretty comfortably or flexibly in terms of IHT between spouses and civil partners. But IHT will still have a role, or IHT considerations should still be a factor if you start introducing, if you start spanning the generations, crossing the generations. So you're talking about bringing in joint owners or co-owners in the next generation, children, grandchildren, etc., etc. Now, Will we always save income tax? Those of you who are regulars will know I wouldn't be asking the question if the answer was that obvious. So let's have a look at one example. Derek and Portia are married. They are both earning salaries of 40k, but Derek also has a residential rental portfolio generating £10,000 of profit after £12,000 of mortgage interest. It's a residential portfolio, so you know what that means for the 12k. That's going to be added back. So thanks to the interest relief restriction, Derek goes significantly into the higher rate band, which 50,000 or just over, and pays tax on his rental profits of 4,346. If you were able to split those profits, etc., equally between Derek and Portia, the tax liability would fall to 1,146 each, thereby avoiding almost all of the higher rate tax on the disallowed interest. And the net saving would be a little bit over £2,000. Now, I'm sure everybody who's sort of tuned into this will be aware that if you spread income across numerous tax-free personal allowances, low rate bands, etc., you're going to save tax. The point that I'm trying to sort of raise here is this issue, which is still catching people out, I think, which is that the residential mortgage interest, finance cost restriction effectively is dragging people on what you might call modest incomes into the higher rate band. So people who think, my total rental income is, let's say, 45,000. I'm comfortably below the high rate band. I don't have anything to worry about from this interest relief restriction. That's quite possibly not the case, because that interest relief restriction is going to drag that person into the higher rate threshold, and therefore spreading the rental income and spreading the mortgage interest payments, as would be the case typically with co-owners, particularly in a family or husband and wife civil partner scenario. That should mean that you will avoid the penalty of the interest relief restriction. So will we always save income tax? Well, let's have a look at another example. Tesla and Kirchhoff are civil partners. They are both earning salaries of 95,000, but Tesla also has a residential rental portfolio generating 45,000 of profit after £10,000 of mortgage interest. Tesla's rental income tax bill on his own would be £25,000 in 2021. I mean, I put 21-22 there. Anybody who's been sort of aware of the budget 2021 knows it's going to be the sort of allowance and bands are going to be static for the next 2 or 3 years, I think. If net rental profits were split equally, instead, Tesla and Kirchhoff would owe £14,500 each, totaling £29,000, costing an extra almost 4k. Why is that? Well, it's because I've craftily set the whole thing around the 100k mark, and some of you, many of you, will already be aware that when you go above the £100,000 income, adjusted net income strictly, threshold, you're in a kind of no man's land, where you start to lose the tax-free personal allowance as your income rises. And it means that the effective or marginal tax rate can hit up to 60%. So by splitting the rental income, etc., across two people in this way, both of them at the bottom of this sort of treacherous tax zone, I've called it here, you're actually doubling the amount of income that is taxed on at a very punitive rate. So this is just to highlight that there can be scenarios where the general assumption that your income will, your income tax bill will always be less if you spread it around across, co-ownership, joint, members of the family, etc. Not always, right? And particularly if you are earning around the £100,000 mark, you should be checking relatively carefully that it is the right thing to do to go into a joint ownership scenario. And again, do bear in mind that if you're saying to yourself, oh, I'm okay, my income is only 90,000, I don't have to worry about the 100,000, yet again, that finance cost restriction for residential property lettings will bite and will drag your income higher, that, for tax purposes at least, higher than you thought it would be. So look at the basic legal position from a non-lawyer. I'm not qualified to advise on legal matters, and based on the strength of some of my webinars, you might think I'm not qualified to advise on tax either. But we're going to try from a tax position, from a tax perspective, to give you a sense of the basic legal position. So what is my ownership interest and why it matters? And what are the main types of joint ownership, co-ownership from a tax perspective, and why that matters? Okay, so with real property, as with most property, but focusing on land and buildings, ownership can be split into two categories. You have the legal interest, which essentially is the name on the deeds or names on the deeds and on the land registry, and the beneficial or equitable interest, which is who gets to benefit from, hence the word, enjoy or use the property. So the legal owner, the sort of person legally responsible for the property, gets their name on the land registry, but somebody else who is the beneficial owner should benefit from any rental income, for example. Now, it can be the same person. I might have a rental property and I might be the legal owner, and I might also be the person with the beneficial interest, the beneficial owner, the person with the equitable interest. But this is particularly relevant for land and property. It can be split in effect. There can be different people with different legal interests. So land and property law can become quite complex. And it is one of the relatively few areas where the legal owner can quite often be different to the beneficial owner, and that it can be relevant and important, particularly from a tax perspective. Now, why? Because income tax, capital gains tax, and IHT, inheritance tax, largely follow the beneficial interest. So whoever stands to make money or to benefit from the property, there's that word again, whoever stands to benefit from the property, the beneficial owner, that's the person who will suffer the income tax or the capital gains tax on disposal, etc., etc. I've had to put there Scottish law. Apparently, your mileage may vary under Scottish law. It's not quite as simple. There's a lot of additional intricacies to Scottish law, which I'm not I'm not the person to ask about that. Okay, so looking at the basic legal forms of joint or co-ownership. So I'm now looking at not an individual's, the sort of different aspects of an individual's interest in a property. I'm now looking at categorization of co-ownership, where there are several people involved, two or more people involved. And that can be in the form of a joint tenancy. Don't blame me for the fact that lawyers use the word tenancy to describe ownership. Or it can be as tenants in common. Joint tenancy, every co-owner, every joint owner has an equal interest in the whole property. So if there are two people, it's 50-50 or 1-to-1. If there are three people, it's 33-33-33. Another aspect of joint tenancy, which is occasionally overlooked even now, I understand, is this idea of survivorship, which is that although you have a right in the undivided asset, you can't pass that interest, your joint interest, onto somebody else through your will. It automatically falls to the remaining or surviving joint owners. That, so I mean that might not be a bad thing if you're in joint ownership with your spouse or civil partner. Who cares? Because you probably want to pass it to them anyway, unless you've got kids, in which case tenancy in common might be the way forwards. Tenancy in common, the co-owners may hold unequal shares in the whole property. So if ever you want to split the interest in the property, the underlying beneficial interest in the property, other than 50-50 or 25-25, 25-25, it will have to be as tenants in common. I should emphasize that you can hold the property equally amongst you as tenants in common. It's not like if you want it equally, it's got to be joint tenancy. If you want it unequally, it's got to be tenants in common. The rule is that if you want to hold it unequally, it's tenants in common. But if you're holding it equally, then it could be either way, if that makes sense. It could be either joint tenancy or tenants in common. The final point to make about tenants in common is that it does allow you to dispose of your interest in that property through your will as you see fit, without it necessarily having to fall to the survivors equally. So a summary of why it matters from the perspective of property investment, etc., etc. Joint tenancy is easy, it's straightforward, but tenants in common is flexible. If you want to hold property on equal shares, it must be as tenants in common. Very similarly, in similar vein, if your co-owners have contributed, so let's say that Amir and I have gone into a joint property venture, and Amir puts up 80% of the funds, he's probably going to want to get 80% of the rental income that comes from that. And say, Lee, you're the junior partner in this venture, so it's only fair that you get 20%. In which case, if you want that underlying split, you're going to go for tenants in common. You've not really got any choice. It's important to mention, though, just as an aside, that joint tenancy does have some advantages, particularly on proving one's estate on probate. Okay, so let's have a move on now to co-ownership versus partnership. So just to recap, we've looked at in terms of legals, we've looked at the nature of one's ownership and a person's ownership. Are we talking about the legal interest in the property or the beneficial interest in the property? We've moved on to sharing ownership, and we have looked at sort of joint tenancy or tenants in common. We're now going to look at comparing mere co-ownership with partnership. Now, to paraphrase the Partnership Act 1890, a partnership exists where persons carry on a business together on a commercial basis. And that's pretty straightforward. And I fully appreciate that the vast majority of people who co-own property will think they're carrying on a business, consider themselves to be carrying on a business, will almost certainly be doing it on a commercial basis. They won't want to be losing money. Let's put it that way. A key point is that no documentation is required for a general partnership, i.e. one of the PA 1890. A partnership can come into existence intentionally or purely by accident. And it does happen that people go into what they consider to be a fairly passive joint venture and end up almost by accident, perhaps unintentionally, in a fully fledged partnership. And there are lots of legal implications for that, which I won't bore you with. But from our perspective, we're going to take a very simplistic approach and say that co-owned property rental businesses, rental activity, will sometimes amount to a partnership and other times not. So we're going to put partnership on a level above co-owned rental property. So you have mere co-owned, a passive, where you're not sort of carrying on a business on a commercial basis. I think most of you will, or will certainly consider yourselves in that position. But for simplicity, we're going to say that a partnership is kind of more than jointly, a mere passive investment. We'll assume that the partnerships involve jointly owned property, but strictly they don't have to. I mean, you can have a partnership that doesn't actually own any assets. But when we're talking about property investment businesses, it's implicit that we're going to be talking about shared investment properties generating income. So why does it matter whether we are mere co-owners, mere joint owners, or in partnership, in a fully fledged partnership? Well, HMRC prefers by far to treat property investment businesses as mere co-owned investment activities rather than full-blown partnerships. And to an extent, we're probably happy to let them get away with that, because on a day-to-day or year-to-year basis, partnership taxation can become quite involved, not least having to file separate tax returns. And we're going to have even more fun with this under Making Tax Digital. And it can involve more complexity and more cost and time and attention, and more penalties for not getting it right, certainly from a tax perspective. However, it does mean that you can, there's more flexibility, and they can, in some certain scenarios, be more generously or easily taxed. I'm going to talk about easements later on. There's more flexibility for profit sharing between partners. Capital gains tax on changing capital sharing ratios in partnership assets co-owned by the partners. There's some easements there, and as one of the queries we'll look at later on is focusing on incorporation, stamp duty, land tax, and there are potential savings or easements there as well. So just looking at a little bit more detail. When it comes to profit sharing, HMRC acknowledges that you cannot challenge the profit apportionment as you might be able to, or as they might be able to, with wages to a family. And this is a direct quote from HMRC's manuals. To be a partner, one need not take an active part in the business at all. Well, contrast that with a scenario where you're paying wages to your spouse or civil partner, and imagine what would happen then if you turn around and said, well, actually, the spouse or civil partner doesn't do a thing. Business income manual will say quite clearly, if they don't actually do commercial work to earn that wage, then it won't be allowed for tax purposes. Whereas profit sharing between partners, not really anything HMRC can do about it. Capital share and partnership assets. It's a special regime to ease changes in fractional interest in partnership assets. So, if it's again, Amir and I are in a property partnership, and he owns 80% of the assets. I own 20% of the partnership assets, but I work much harder than Amir does. You may disagree, and Amir says, we're going to change the underlying ownership of these assets, and I'm going to take a lower share, transfer some of that share to you. If it's within a partnership wrapper, if these are partnership assets, there's a special regime which says that's okay. Don't immediately trigger capital gains tax left, right, and centre for transferring assets. But remember, I'm not talking about spouses here. I deliberately chose Amir last time I checked. We weren't married. A lot of you will be interested only in husband and wife, civil partnership, joint ownership, but it's a big bad world out there. It's not always protected by the interspousal, the CGT rules for interspousal transfers. And if Amir were to give me a 20% stake in any old property, he would trigger a capital gains tax bill on himself for his large S. Finally, SDLT, I've touched on this already. There's a special regime to ease incorporating a partnership owning chargeable property assets. So that regime means it may be possible to avoid the SDLT charge otherwise arising. Now, that regime was aimed at professionals, allowing professional partnerships to easily incorporate without triggering a massive SDLT, a prohibitive SDLT charge on their property assets. But it can also apply to property rental businesses. Okay. Well, final point about partnership and capacity, tax treatments. The easiest way to is by way of an illustration. So putting to one side any partnership rental businesses. HMRC says that Marco bundles together his rental income and losses from all UK properties. So ignore furnished holiday lettings. He owns on his own, and or any of his shares, his slices of income from jointly held property. So he has 3 properties he owns outright. Those all get lumped together. Alongside that is his 25% stake in a property he owns with his 3 siblings, and also a property that he lets jointly with his civil partner. So that all gets lumped together. Any rental partnership profits or losses must be held separately because they are deemed to be held in a separate capacity, i.e. as partner in that business rather than mere joint owner. So that can be a complication, particularly if you're in the position of being a partner in some rental business ventures and a mere joint owner in others. I want to move now on to key pitfalls and common mistakes. We're going to cover spouses and civil partners, rental profit sharing, and Form 17. If I had a dime for every time I've come across somebody making a mistake with a Form 17, I'd have at least $1. Co-ownership generally. So again, speaking simplistically, we're talking about the sort of mere joint investors. We'll talk about rental profit sharing, settlements, anti-avoidance. Don't be scared. It's good news. Joint ownership and SDLT and equivalents. That may be a little bit more complicated there. I should also add, because I haven't picked up on it despite having made notes to do so, that when I talked about SDLT, stamp duty land tax, of course we're now in a scenario where SDLT applies only in England and Northern Ireland, and you have land and buildings transaction tax in Scotland, and you have land transaction tax in Wales. The rules are very similar, but you must, if you are dealing with property that's subject to either of the other regimes, LBTT or LTT, you must check that the rules apply as I put here, because there are some fine differences, and as those 2 new regimes mature, they are moving ever so slightly away from the sort of parent SDLT regime. Finally, property rental partnerships with capital gains tax and SDLT. So where property is held in joint names between spouses or civil partners living together, the income is split 50-50, regardless of the actual split in underlying beneficial ownership. So I spent 10 minutes going on about how important beneficial ownership is, and about tenants in common, allowing you to have an unequal split. And then I've gone here and said spouse and civil partners, the default position, if it's owned in joint names, 50-50, and your actual ownership is irrelevant unless it's actually a partnership. So again, another reason why partnerships are important is to establish whether or not you're in partnership. Or it's furnished holiday accommodation, or you use Form 17 to notify HMRC officially of that unequal split in beneficial ownership. I'm going to focus on that in a bit more detail. Emphasize you do not have to submit Form 17. There are lots of scenarios where you might own your property unequally, beneficially speaking, and you're perfectly happy for it to be split 50-50. So just leave it as it is. You don't need to submit a Form 17. I have to emphasize that the Form 17 regime is widely misunderstood, and not just by landlords and landladies, but accountants and tax advisors sometimes make mistakes here as well. If you own property unequally, but actually want the income to be taxed 50-50, you can. Form 17 is not mandatory just because the property is held unequally. It is optional. Also, you do not have to notify within 60 days of a fresh split of beneficial ownership. The Form 17 refers to a 60-day time limit. The 60-day time limit is how old the signatures can be, how old the form is before HMRC will accept it. And it's to prevent backdating. So if you wake up one day and say, maybe tomorrow, we should have split our income 4-1, and we've been putting up with 50-50. We should have split our income 4-1. I only own 20%. You own 80%. Let's write to HMRC and get a Form 17 in. You might want to say, oh, I want to go back to 2005. Well, tough, because the Form 17 that sort of instructs a non-equal split, an unequal split, can only be 60 days old for HMRC to accept it. A Form 17 has to reflect the actual split of beneficial ownership. It's not a trigger that you say, oh, it's not equal, so therefore from now on I can do whatever I want. If you send in a Form 17 saying that the split is 70-30, that is the split you must then use, and no other. A Form 17 cannot be revoked, no matter how hard you try. You can't revoke it, you can't withdraw it. Once submitted, the corresponding income split must continue to be used unless there's a death in the couple, or divorce or separation, which basically breaks the framework of the legislative provision, until there is another change in the underlying beneficial ownership. Because if you said in one Form 17 that it's 30-70, and then 18 months later you decide to go for 60-40, that original Form 17 is now void. Now, you don't have to submit a replacement Form 17. And if you don't, the second that you move away from that original split, you actually flip back to 50-50. Okay? Until you decide to submit a fresh Form 17, say, oh, actually, we've now changed it. We've changed it from 70-30 to 60-40. And actually, you could have 70-30, change it to 60-40, not submit a Form 17 for 2 years, change it again to 35-65 or 90-10, wait for a bit, and then submit a Form 17. It's entirely your option. You can kind of step off the Form 17 or step out of the Form 17 regime or notifications as you choose. Okay, moving away from Form 17, some of you will be relieved, and looking at rental profit sharing between non-spouses. So this could be non-spouses, non-civil partners. So this could be siblings, 2, 3, 4, 10, depending on how large your family is, or friends, or whatever. Now, having told you all about the rigors of the Form 17 regime, actually, while HMRC expects income share between joint owners generally to reflect their underlying beneficial ownership, HMRC quite happily accepts that joint owners may agree a different split if they choose, just not retrospectively. So, for example, Amir and I, 80-20, Amir says, do you know what, Lee? I don't need the cash this year. You have more. Let's split the profits 50-50. Or you've worked particularly hard this year. Yes. And we're going to split it 40-60 in your favor from now on. That's perfectly fine. I know to my cost that lots of people believe that I am wrong in this, including solicitors. They need to read the tax legislation, which and the guidance around the tax legislation, which effectively says that the only time that HMRC can invoke the settlements anti-avoidance legislation to sort of bring it back to the respective beneficial interests is if they can show that Amir is saying he's giving me more income than my underlying beneficial ownership would support, and then there's some kind of agreement whereby I give that money back to it. Okay, so outside of husband and wife, civil partner, or arrangements involving your young or minor children, if it's effectively two unconnected parties or siblings, the settlements anti-avoidance legislation is much harder to invoke. So there is a lot more flexibility. What I'm trying to get to is the fact there's a lot more flexibility in terms of profit share than some appreciate. Okay. Joint ownership and SDL. Now this is not good news. I said mistakes. I didn't say it was all bad news. But this, you've had the good news. We're now back to pitfalls. Joint ownership and SDLT, the higher rate and additional dwellings, 3% surcharge for SDLT. If one of the joint owners is exposed to the 3%, everybody's exposed, and the 3% surcharge is applied to the entire consideration. Now, there are savings for scenarios where a party is providing funding or support. So maybe the mortgage lender, the mortgagee, has said parents have to act as guarantors. Parties on the named in the mortgage. We want you on the title deeds, let's say. So they're down as one of the legal owners or legal co-owners, but that's it. They have no stake in the bricks and mortar or the land itself. They don't have any beneficial interest. They're not, they've either lent money or agreed to stand in as guarantor. Then they will be okay because there's no value attaching to to mere legal ownership. Okay, so that is another scenario where it's important to distinguish between having your name on the paperwork and on the land registry and actually having an underlying beneficial interest in the property itself. And again, I understand it applies similarly in Scotland and Wales with their respective regimes, but do check, please. Okay, capital gains tax. We're looking at property partnerships now. So we're looking at the sort of normally that higher tier that sort of carrying on a business with a view to a profit, with a view of profit. Having said earlier, there are easements for partners changing their underlying beneficial interest from one year to the next. So going back to where Amir was saying, you've worked very hard this year, and I'm going to give you a larger stake in the partnership assets. So CGT will typically not be charged until a partner retires or the asset is sold outside the partnership, or, for want of a better phrase, real money, real consideration changes hands. HMRC decided in 2008, which is over a decade ago, that those easements do not apply when a partner first joins and introduces fresh assets to a partnership. So let's forget spouses and civil partners and their special protection from CGT. And let's go back to, or go to any other scenario. If I am in a partnership with Isabel, I've got an investment property, Isabel's got 3 investment properties, and we're just quite happy sitting there, and she owns hers and I own mine, and we say, I know, let's go into partnership. That could, and in HMRC's eyes, should trigger capital gains tax. If we sort of merge our individually owned properties and turn those into partnership assets, then it will be triggering CGT charges, potentially left, right, and centre, by virtue of HMRC's revised interpretation of its long-standing rules for treatment of capital gains within partnerships, Statement of Practice D12, which was substantially overhauled several years later than 2008. I think about 2015. I think it took so many years to actually update SPD12. Okay, so that's just to warn you that if you go into a partnership and you're not protected by being spouses or civil partners, that you can trigger capital gains tax on introducing assets. And again, if you accidentally become a partnership and you didn't realize you were, this could be quite catastrophic. Again, spouses and civil partners are protected from all this. Non-spouses, including other family members or friends or just people you want to go into business with, you're not protected. You need to be aware of the capital gains tax implications of accidentally going into partnership with somebody and creating a partnership with assets. Now, it's not always a lost cause. You may not have, it may not be the case that you intended to create partnership assets. They may still belong only to you. It's potentially possible to hold over the game, but probably beyond where we are now. SDLT. Okay, so we have a similar scenario here. While there are easements to prevent SDLT from essentially land tax from being charged when, for example, a property investment partnership changes its constitution, its members or individual partners, there can still be charges if I as a prospective partner come in with some chargeable property and say, right, I'm going to introduce this is my buy-in. I'm going to introduce this property into the overall partnership portfolio. That again, similar to CGT, is going to potentially trigger SDLT charges. It's quite complex. I am acquiring interest in the other partners' partnership assets. They're acquiring interest in my in my assets being introduced. And the final kicker, and this is really important, is that SDLT is triggered on a change in property income sharing ratios. It is not what you think. You'd expect it to be capital sharing ratios. It isn't. It's income sharing for property investment partnerships. Non-property investment partnerships, any other partnership, professional partnerships, construction partnerships, whatever, they don't have to worry about this. But if the income sharing ratio in a PIP changes, it can trigger SDLT. And that is very important because landlords and some advisors who think it's a very straightforward matter to say, oh, we're not joint owners with a property partnership. We have been for a number of years. Yeah, we changed our profit share from 1 year to the next. HMRC will be delighted to introduce you to the legislation which says that when you change your property income sharing ratio, you might have triggered an SDLT charge. So that could be a load of SDLT charges before you get to the SDLT charge you were hoping to avoid on incorporation. So what have we learned? Do not give this man a second series. Splitting income or ownership across one or more co-owners will generally lower tax exposure. And that could be income tax, could be capital gains tax, even inheritance tax, intergenerational. So we're not just talking about between spouses or civil partners because they're generally protected for IHT purposes, but not always. And those with higher incomes, you know, if you're approaching that 100,000, in particular, if you're approaching that £100,000 income or just net income threshold, be careful. You're not going to actually walk yourself into a greater exposure to punitive marginal rates. When it comes to legal or beneficial ownership, the nature of a person's ownership is usually the beneficial ownership that matters for tax purposes. Income tax, capital gains tax, inheritance tax follows beneficial ownership. Who has the right to benefit from the property? So the actual name on the land registry may be purely coincidental. I wouldn't say irrelevant, but of only passing relevance. When it comes to sharing ownership, joint or co-ownership, sharing ownership between persons, holding as tenants in common is more flexible than joint tenancy. So you can split it unequally. You can pass your share on death through your will. If you want unequal shares in property, then it must be tenants in common. People often misunderstand how Form 17 work to split income unequally between spouses and civil partners holding property in joint names. Yes, they do. Property rental partnerships can come about by accident or intentionally, even if HMRC doesn't like them, because the HMRC guidance says, oh, you're almost never going to see a property property partnership, property rental business in a partnership. It's almost always going to be joint. And actually the criteria that they give to sort of move it from just being mere passive investment to an actual active partnership are highly questionable, but be careful what you wish for, because actually partnership or becoming a partnership, particularly the transition from being mere joint investors to a partnership, could trigger unexpected CGT and SDLT baggage, particularly between non-spouses, because yes, there are co-owners, joint investors who aren't married to each other. Okay. Q&As. Denise, how would you find out if property was joint ownership or tenants in common? I'm not a solicitor, but if the property is held unequally, it cannot be a joint tenancy. So if the underlying beneficial ownership is anything other than 50-50, it must be tenants in common. If it's split equally, then it could be either. So check the deeds, ask a solicitor, or if the land registry title, the Form A restriction, if the land registry title has a restriction as put out there, as set out there, no disposition by a sole proprietor of registered estate except a trust corporation under which capital money arises is to be registered unless authorised by an order of court. If that restriction is there, then it's tenants in common. Pradeepan, two pages, 2 slides for you, Pradeepan. Form 17, can this be done for a couple without making any changes to the title, to the legal interest? Yes, because Form 17 merely notifies HMRC of an uneven split in beneficial ownership. So affects a change in income share for tax purposes only. Does not change the ownership, it merely reflects the beneficial ownership. Ownership may change and then Form 17 may be used or not. Can this be done only for couples and not for others? Basically, yes. Can't use a Form 17 if you're not married or in a civil partnership and living together. It applies only to spouses and civil partners who are living together. But remember, co-owners who are not married or in civil partnership can largely agree to split incomes as they like, regardless. They don't have to follow the underlying beneficial interest or their respective underlying the split of beneficial interest. Form 17 is a relieving mechanism from the constraints of how married couples and civil partnerships are taxed. So it's quite a rigid regime for taxing joint investment property in joint names between spouses and civil partners. So the Form 17 is a safety valve, for want of a better expression. And unmarried co-owners don't need it. Part 2. Can HMRC challenge the percentage split if the higher rate earner is given only 1%? No, not as far as I'm aware. I'm not aware of the split ever having been challenged at any extreme, 99 to 1, 99.9 to 0.1. I myself have never ventured beyond 5% that I can recall. But I'm not particularly precious about it. If we don't file another Form 17, will CGT be based on the last filed Form 17 or based on the actual ownership? 50-50, as they will be joint tenants. Deepan, I have questions now, because when you say another Form 17 suggests one has already been submitted, and as I have said numerous times now, if a Form 17 has been submitted to say, oh, by the way, we don't own this equally, it must have been as tenants in common. So they can't be joint tenants, or they can't have been joint tenants when that original or that previous Form 17 was submitted. So it's extremely unlikely in this scenario that there can be a valid Form 17 and joint tenancy today. Not impossible, because you can move from tenants in common back to joint tenancy or to joint tenancy. You have to set up a trust to do it. It's easy to sever joint tenancy to tenancy in common, but it's harder, it's legally more demanding to move from tenancy in common to joint. Not impossible, but it's balance of probabilities. You may need to see me after class. CGT is based on beneficial ownership, and so is the Form 17 declaration. But a couple does not, so this is actually answering your question rather than ranting on, but a couple does not have to file a Form 17 unless it wants a particular income tax treatment. So even if it does file a Form 17, it doesn't have to keep filing them, even if they change the underlying beneficial ownership again. So CGT may therefore accidentally reflect the last Form 17 declaration, but in no way does it have to. Teresa, if a husband and wife have joint ownership of property portfolio, have a partnership agreement in place of 50-50 ownership, but have not been filing partnership tax returns or indeed registered with HMRC as a partnership, would HMRC treat this as co-ownership and therefore no benefits on CGT? We talked about the good parts of a partnership being able to incorporate, for SDLT purposes at least, and swerve an SDLT charge potentially. The client's previous accountant has been completing the property page of the self-assessment rather than having registered as a partnership and completing a partnership return. The direct answer is it is a matter of fact whether or not the co-owned property business is operating as a partnership. A partnership agreement does not of itself turn it into a partnership, although it may well be strongly indicative of the parties' intentions. So therefore, it's conceivable, and it has happened, that you have a partnership agreement saying, yeah, we're partners. You're not partners. You need actually to be carrying on business in common with a view of profit. And if you're not doing that, doesn't matter what the partnership agreement says, you're not a partnership. It's not the same if you're an LLP. We're talking about general partnerships governed by the PA 1890 here. Therefore, if you have good evidence that a partnership exists, that can overcome the lack of a partnership return, and that has happened over the last few years, and you can work out why. However, diligence is essential. Beware possible CGT and SDLT implications of creating, for want of a better word, a partnership at some point in the past. We've covered that in some detail. Have they always been protected for CGT by there being interspousal transfers? Watch Safer Practice 0308. Historic Form 17 would not have been appropriate in a partnership because they're already able, as a partnership, to flex their profit share without needing to resort to Form 17. Special rules for SDLT and property investment partnerships. Watch any changes in income, profit share, and even potential VAT implications if, say, commercial property is involved. Now, I've gone a bit beyond the question raised, because the question suggests, it's easy to infer from the question, that we've got a simple 50-50 partnership or joint ownership scenario, and it may always have been that, and there's no suggestion there is commercial property. However, I have seen some absolute howlers over the last few years, advice given by accountants, tax specialists, where there's just been a presumption that a partnership, and none of these things have been properly considered. It is much more complicated than some people seem to appreciate. And that's why I emphasize diligence on this and careful consideration of the implications of what you're kind of potentially maneuvering this joint ownership into when you say, oh, it's a partnership. Just, you need to be careful, and you need in particular to vet the history, and that history could go back many years. And it's not good enough to say, well, they're a partnership now. They could have been there. We just don't know when they were a partnership. We don't know when they became part. It doesn't matter now today, really, does it? HMRC will tend to say yes, because we want to know whether or not there are charging instances going back potentially several years. And as it happens, the appendix to the report goes into several pages of detail about whether or not you actually comprise a partnership as distinct from joint owners. Faiza, I own a property which is technically owned by my sister and me. However, it is my property as I purchased it and added my sister to the mortgage when I was in financial difficulty, and she lived with me for a few years, etc. My sister can confirm this. How can we avoid her having to pay any CGT on the sale of this property? This isn't entirely clear, because you're saying your sister has been added to the mortgage when you're in financial difficulty, but you've also said that you've paid the mortgage throughout. Now, she might have been added to the mortgage simply as guarantor, or she may have been contributing towards the mortgage itself. However, strictly speaking, taking on responsibility for the mortgage does not necessarily mean that your sister has acquired a beneficial interest in the property. She might have a legal interest. Her name might have been added. Her name might have been added to the deeds or to the land registry, but that does not necessarily mean. So that's legal ownership or legal interest in the property. That doesn't mean she necessarily has a beneficial interest. However, a disposal may well trigger HMRC to ask the question, because they are plugged into the land registry, and they will see a disposal, they will see her name, and they will go, why is she not reporting anything? Having said all that, if you are able to show that your sister at no time had a beneficial interest in the property, then CGT should not be in point. Carol, at present I have a rental apartment in the UK. I am the sole owner. Could my husband and I set up joint co-ownership if we are now both residents in Spain? That's a legal question, Carol, and I am a tax advisor, but I'm not aware that tax residence affects the basics of legal or beneficial ownership of UK real property. So as a non-lawyer, if so, would this be tax efficient? And my answer to that is maybe, but it would depend on a number of factors not yet covered in the questions presented. So yeah, it sounds like it well could, but we don't yet know. I still pay tax on rental in the UK, but my husband pays no tax in the UK at present. I imagine he would have to start paying tax in the UK if we set this up. Again, maybe. I don't know, because we don't know if he's going to exceed his UK personal allowance. Is it already being used elsewhere? Is it still fully available? Is he entitled to a UK personal allowance? What are your respective marginal rates of UK income as well? Implicitly, this is nil, but we don't know what yours is. So, you know, nothing that you've said is wrong, but we need a fuller question to provide a fuller answer. Most importantly, I'm a UK tax advisor. Don't ask me anything about Spanish tax. And you know, if you're a resident for tax purposes in another country, you absolutely must check the tax implications, the domestic, local tax implications of any UK related transactions you're contemplating. So there's Spain's domestic tax code, there's a double tax treaty, and also IHT. The IHT implications could dwarf any sort of annual income tax saving. Particularly, the implications, I'm not saying that the savings could dwarf the income tax saving, particularly if one or both of you is not domiciled in a UK jurisdiction. And that is me done.